The stock market is tanking right now, red screens everywhere, your portfolio value is dropping, and that little voice inside your head is screaming, "Sell it all before it's too late." But what if I told you that voice could be steering you toward the biggest financial mistake of your life? Hey everyone, welcome back to the channel. If you're feeling anxious about the current market crash, you're not alone. I've been there too. But today, I'm going to share with you exactly why smart investors don't fear market crashes. They prepare for them, and even use them to their advantage. In the next 10 minutes, you'll learn proven strategies to protect your investments during market downturns, why panic selling is the enemy of wealth, and how dividend investing can be your financial lifeline during turbulent times, whether you're investing in the US, UK, Europe, or anywhere else in the world. This isn't just theory. I've personally used these exact strategies through multiple market corrections, including in my UK stocks and shares ISA, and I'm going to break it all down for you today. Let's dive in. First, let's get some perspective. Market crashes aren't rare anomalies. They're a normal part of the economic cycle. Since 1928, the S&P 500 has experienced 26 corrections, drops of 10% or more, and 9 bear markets, drops of 20% or more. And yet, its overall trajectory has been consistently upward. The same patterns exist in markets worldwide, from the FTSE in the UK to the Nikkei in Japan and beyond. Here's what many new investors don't understand. Market crashes are temporary, but the losses from panic selling can be permanent. Consider this. If you had invested £10,000 in the FTSE 100 just before the 2008 financial crisis and sold at the bottom, you'd have lost nearly 50% of your investment. But if you'd simply held on, not only would you have recovered your original investment within about 4 years, but today, with dividends reinvested, you'd be significantly ahead. The same principle applies to every major market worldwide. Patient investors get rewarded, emotional traders get punished. So why do so many people make the mistake of selling during market downturns? It's all about psychology. Our brains are wired for survival, not for investment success. When we see our portfolio value dropping, it triggers the same fight or flight response that protected our ancestors from predators. Your brain treats financial loss as a physical threat, and it desperately wants you to take action to stop the pain. Studies have shown that the pain of losing money is psychologically about twice as powerful as the pleasure of gaining it. This is called loss aversion, and it's a major reason why investors make poor decisions during market crashes. But here's the truth. Market volatility is the price you pay for long-term returns. The temporary discomfort of watching your portfolio decline is the admission fee for the long-term benefits of stock market investing. Warren Buffett said it best. The stock market is a device for transferring money from the impatient to the patient. I remember during the COVID crash in March 2020 watching my own portfolio drop by over 30% in just a few weeks. It was gut-wrenching. But instead of selling, I reminded myself of the historical precedent and actually added more to my investments. Within a year, those same investments had not only recovered, but were up significantly. So how do you properly protect your investments during market crashes? Let me share 5 proven strategies that work globally. 1. Portfolio diversification. Proper diversification means spreading your investments across different asset classes, stocks, bonds, real estate, maybe even a small allocation to precious metals. Also, different geographies, domestic and international markets. And lastly, different sectors, not just tech or energy, but a balanced approach. For example, in my portfolio, I hold UK stocks in my ISA, but also have exposure to US, European, and emerging markets through index funds. 2. Emergency fund first. Before investing a single pound, dollar, or euro, ensure you have 3 to 6 months of living expenses in an easily accessible savings account. This prevents you from being forced to sell investments at the worst possible time. 3. Dollar cost averaging. Continue investing regularly regardless of market conditions. When prices drop, your regular contributions buy more shares. This lowers your average cost basis over time. Quality over speculation. In bull markets, speculative stocks can soar, but during crashes, it's quality companies with strong balance sheets, competitive advantages, and sustainable business models that survive and thrive. Appropriate asset allocation based on time horizon. If you're decades from retirement, you can afford to be heavily weighted toward equities. If you're nearing retirement, a more conservative allocation makes sense. Remember, these principles work whether you're investing in an American 401k, a British stocks and shares ISA, a European pension fund, or any other investment vehicle worldwide. Now let's talk about why dividend investing deserves special attention during market crashes. While stock prices can be extremely volatile in the short term, dividends tend to be much more stable. Companies with long histories of paying and increasing dividends typically prioritize maintaining those payouts even during difficult economic times. Here's why this matters during market crashes. First, cash flow regardless of market conditions. When you own quality dividend stocks, you continue receiving income even when share prices are down. This cash flow can provide psychological comfort during market turbulence. Second, dividend reinvestment at lower prices. Market crashes actually create opportunities for dividend investors. When you reinvest dividends during downturns, you're buying more shares at discounted prices. For example, £10,000 invested in dividend stocks yielding 4% with dividends reinvested and a conservative 2% annual dividend growth rate would grow to approximately £30,000 in 20 years, even if the share price never increased. Add in any share price appreciation, and the results become even more impressive. Depending on where you live, dividend investing may come with tax benefits. In the UK, you can hold dividend stocks in an ISA and pay zero tax on dividends. In the US, qualified dividends are taxed at lower rates than ordinary income. Many other countries have similar preferential tax treatment for dividend income. Quality filter. Companies that have paid consistent dividends for decades typically have strong balance sheets, sustainable business models, shareholder-friendly management, and cash-generating businesses. These are exactly the kinds of companies that can weather economic storms. In the UK, companies like Unilever and Diageo have impressive dividend histories. In the US, companies like Johnson & Johnson and Procter & Gamble have increased their dividends annually for over 50 consecutive years. Similar dividend champions exist in markets worldwide. Let's make this actionable with specific steps. First, review your current portfolio. Evaluate whether your investments are properly diversified and aligned with your time horizon and risk tolerance. Second, build your dividend foundation. Consider allocating a portion of your portfolio to dividend-focused investments. Think about individual quality dividend stocks, dividend-focused ETFs or index funds, and REITs for real estate dividend exposure. 3. Set up automatic investment plans. Automate your regular investments to remove emotion from the equation. 4. Create a market crash action plan. Write down exactly what you'll do during the next market crash. Review, but don't obsessively check your portfolio. Increase investment contributions if possible. Focus on quality dividend payers trading at discounts. And remind yourself of your long-term goals. 5. Tax optimize your investments. UK investors, maximize your £20,000 annual ISA allowance. US investors, utilize tax-advantaged accounts like 401ks and IRAs. International investors, research the tax-efficient investment structures in your country. Remember, market crashes aren't the time to abandon your strategy. They're the time to execute it with discipline. The next time you see those alarming headlines about market crashes, remember this. Throughout market history, the winning strategy has never been to panic and sell. It's been to stay calm, stick to your plan, and even capitalize on the opportunities that market fear creates. As dividend investors, we have a unique advantage during these times. While others are panicking about price fluctuations, we're collecting our dividends, reinvesting at lower prices, and building wealth for the long term. When I first started investing, market drops terrified me. Now, with the perspective and strategies I've shared today, I view them as an inevitable and even beneficial part of the journey to financial freedom. If you found this video helpful, please hit that like button and subscribe to the channel for more practical investing wisdom. Share this with someone who might be feeling anxious about the current market situation. You might just save them from making a costly financial mistake. Drop a comment below with your own market crash survival tactics or any questions you have. I personally read and respond to as many comments as possible. Until next time, remember, in the world of investing, diamond hands win the long game. Happy investing.